One of the simplest ways for companies to communicate financial well-being and shareholder value is to say the dividend check is in the mail. Dividends, those cash distributions that many companies pay out regularly from earnings to stockholders, send a clear, powerful message about future prospects and performance. A company's willingness and ability to pay steady dividends over time and its power to increase them provide good clues about its fundamentals. And one of those clues is the dividend yield. Today, we will discuss the dividend yield and why it's important. A company's ability to pay out regular dividends or cash distributions goes a long way toward communicating its fundamental strength and sustainability to shareholders. In general, mature, slower growing companies tend to pay regular dividends, while young, faster growing companies would rather reinvest the money towards growth. The dividend yield measures how much income has been received relative to the share price. A higher yield is more attractive, while a lower yield can make a stock seem less competitive relative to its industry. The dividend coverage ratio, which is the ratio between earnings and the net dividend shareholders receive, is an important measure of a company's well-being. Companies with a history of rising dividend payments that suddenly cut them may be having financial trouble. Similarly, mature companies that are holding on to a lot of cash may also be having problems. Before corporations were required by law to disclose financial information in the 1930s, a company's ability to pay dividends was one of the few signs of its financial health. Despite the Securities and Exchange Act of 1934 and the increased transparency it brought to the industry, dividends still remain a worthwhile yardstick of a company's prospects. Typically, mature, profitable companies pay dividends. However, companies that do not pay dividends are not necessarily without profits. If a company thinks that its own growth opportunities are better than investment opportunities available to shareholders elsewhere, it often keeps the profits and reinvests them into the business. For these reasons, few growth companies pay dividends. But even mature companies, while much of their profits may be distributed as dividends, still need to retain enough cash to fund business activity and handle contingencies. The progression of Microsoft through its life cycle demonstrates the relationship between dividends and growth. When Bill Gates' brainchild was a high-flying growing concern, it paid no dividends, but it reinvested all earnings to fuel future growth. Eventually, this 800-pound software gorilla reached a point that it could no longer grow at the unprecedented rate that it had maintained for so long. So instead of rewarding shareholders through capital appreciation, the company began to use dividends and share buybacks as a way of keeping investors interested. The plan was announced in July of 2004, nearly 18 years after the company's IPO. The cash distribution plan put nearly $75 billion worth of value into the pockets of investors through a new 8-cent quarterly dividend, a special $3 one-time dividend, and a $30 billion share buyback program spanning 4 years. In 2019, the company is still paying dividends with a yield of 1.32%. Many investors like to watch the dividend yield, which is calculated as the annual dividend income per share divided by the current share price. The dividend yield measures the amount of income received in proportion to the share price. If a company has a low dividend yield compared to other companies in its sector, it can mean two things. Number one, the share price is high because the market reckons the company has impressive prospects and isn't overly worried about the company's dividend payments. Or the company is in trouble and cannot afford to pay reasonable dividends. At the same time, however, a company with a high dividend yield might be signaling that it's sick and it has a depressed share price. The dividend yield is of little importance when evaluating growth companies because, as we discussed above, retained earnings will be reinvested in expansion opportunities, giving shareholders profits in the form of capital gains. Think about Microsoft. While a company having a high dividend yield is usually positive, it can occasionally indicate that a company is financially ailing and has a depressed stock price. All right, let's talk about the dreaded dividend cut. If a company with a history of consistently rising dividend payments suddenly cuts its payments, investors should treat this as a signal that trouble is looming. While a history of steady or increasing dividends is certainly reassuring, investors need to be wary of companies that rely on borrowing to finance those payments. Take, for example, the utility industry, which once attracted investors with reliable earnings and fat dividends. As some of those companies were diverting cash into expansion opportunities while trying to maintain dividend levels, they had to take on greater debt levels. Watch out for companies with debt to equity ratios greater than 60%. Higher debt levels often lead to pressure from Wall Street as well as from debt rating agencies that in turn can hamper a company's ability to pay its dividend. Dividends actually bring more discipline to a management's investing decision making. Holding on to profits might lead to excessive executive compensation, sloppy management, and unproductive use of assets. Studies show that the more cash a company keeps, the more likely that it will overpay for acquisitions and in turn damage the shareholder value. In fact, companies that pay dividends tend to be more efficient in their use of capital than similar companies that do not pay dividends. Furthermore, companies that pay dividends are less likely to be cooking the books. Let's face it, managers can be awfully creative when it comes to making earnings look good. But with dividend obligations to meet twice a year, manipulation becomes that much more challenging. Finally, dividends are public promises. Breaking them is both embarrassing to the management and damaging to share prices. To tarry over raising dividends, never mind suspending them, it seems as a confession of failure. The evidence of profitability in the form of a dividend check can help most investors sleep easily. Profits on paper say one thing about a company's prospects. Profits that produce cash dividends say another thing entirely. Well, that about wraps up this video. And if you found value with what we've talked about today, please subscribe, like, and share the video. Until next time, hey Dividend! I've got my eye on you.